Welcome back to the channel where I bring part 2 of my series on how to become a better investor. The second piece of advice that I have is not investing emotionally, but instead based upon factual information. If you get caught up with your emotions while you're investing, it can cause you to make bad decisions that will ultimately lose you money. Making money in the stock market is not based upon short-term ups and downs, which are inevitable and will always occur. But for a lot of people, they will invest based on these short-term changes and will get emotionally attached to the companies that they've put their money into and quickly buy or sell because they'll see deviations in share price.
You don't need a lot of brains in this business. I mean, I've always said if you got an IQ of 160, give away 30 points to somebody else because you don't need it in investments. What you do need is emotional stability. You have to be able to think independently, and you have to be, when you come to a conclusion, you have to really not care what other people say and just follow the facts and follow your reasoning. And that's...
For example, if you put your money on a company simply because it's been rising in value over the past month, without knowing anything about the company and its long-term outlook, and then quickly sell your shares as soon as it drops in value, this is not a good long-term approach and will ultimately cause you to lose money and make investing a stressful and challenging task. If you invest with emotion, it can cause you to put your money into a business that is ultimately unprofitable and not good in the long term, just because you may have seen the share price quickly going up in value, and then thinking to yourself, oh, the share price has gone up by X amount in a month and it's dropped a little bit. I'll just hold it and keep the company and wait for it to go up again. But a company doesn't have to go up in value. If the business isn't doing well and it's not a good high quality business that's worthwhile investing in, if the share price drops and continues to drop, it might never come back and you'll have lost your money because you just thought in the short term based on emotion.
Carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. I mean, if anybody could predict interest rates right 3 times in a row, they'd be a billionaire. But I'm trying to tell you it'd be very useful to know what the stock market's going to do. It'd be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, or interest rates going to be 12%. That's useful stuff. You never know it, though. There are economic facts and there's economic predictions. And economic predictions are a total waste. And interest rates, Alan Greenspan's a very honest guy. He would tell you that he can't predict interest rates. He could tell you what short rates are going to do in the next 6 months. Try and stick him on what the long-term rate will be 3 years from now. He'll say, I don't have any idea. So how are you, the investor, supposed to predict interest rates if the head of the Federal Reserve can't do it?
It is not trying to predict the market. As discussed in the video clip, it's a complete waste of time and something that no one can do. The main thing you should keep in mind is that the stock market will drop by 10% every 2 years and by 25% every 6 years. Keeping this in mind can help you make a lot of money and reduce the stress that can come with investing. Simply waiting for good opportunities to arise and considering that they take time for them to come up will stop you from trying to make short-term predictions in relation to what's happening in the market. Only buying companies when there's been a dip in share price is always a good way to make money because you're essentially buying the company at a discounted price or a margin of safety in relation to its intrinsic value. The intrinsic or fair value of a company is considered to be the true value of the business. And when you're getting a company at a margin of safety or discounted rate, think of it the same as getting something on sale. You're getting it cheaper than what it's actually worth, and therefore when you're buying it below its value, you automatically make money. This is a method used by Warren Buffett, and it's what he highly recommends if you want to make money in the stock market long term. Well, that wraps it up for the video. I hope you found these tips useful and you can use them to improve your investment strategies and make a greater return with the companies that you buy. If you'd like to watch any more future videos or subscribe to the channel, feel free to click the links on screen, and I'll see you in the next video.